So you either have an annuity, or maybe you're in line to inherit one. Either way, there's one huge question that needs an answer. What happens to that money when the owner dies? It sounds simple, but trust me, the answer is packed with confusing rules and some really costly traps. So let's break it all down so you can be ready. And believe me, this isn't just some boring paperwork. Literally, one wrong checkmark on a form you filled out years ago and forgot about could cost your family thousands of dollars in surprise taxes or even legal fees. We're here to help you sidestep all of that. Here's our roadmap. First, we'll cover the basics of what happens to the annuity right after death. Then, we'll get into who inherits it and the different rules for different people. We're going to explore how the choices you make today dictate what your family gets later. Then, of course, we have to tackle the big one, taxes. After that, we'll spotlight the most common mistakes so you can avoid them, and we'll wrap it all up with a clear, step-by-step action plan. Okay, so first things first, what actually happens to the money? The single most important benefit to know about is that if you've named a beneficiary, that money gets to bypass probate. And if you don't know, probate is that whole long, expensive, and frankly, painful court process for settling an estate. Avoiding it means your heirs get the money faster, cheaper, and with way less of a headache. Now, this is all possible because of something called the beneficiary designation. And this is the part that trips so many people up. That designation, that name on the form, is so powerful it actually overrides your will. You could have a will that's perfectly drafted and updated, but if that old annuity form still names your ex-spouse, guess what? They get the money. That beneficiary form, it's the king. It trumps your will every single time.
All right, so we know the money bypasses the court system, but who gets it and what are the rules they have to play by? Because in the world of annuities and the IRS, not all beneficiaries are created equal.
Okay, this is a huge deal. The difference between a spouse and a non-spouse beneficiary is night and day. A surviving spouse gets this amazing superpower, basically. It's called spousal continuation. It lets them just take over the annuity, put it in their name, and let it keep growing tax-deferred. It's the most flexible option by far. But for your kids, your brother, anyone else? Nope, the game is totally different. They can't become the new owner. They have to take the money out based on very strict IRS timelines, which often means a much bigger tax hit, much sooner. And here's another one of those little checkboxes with massive consequences. Per stirpes versus per capita. Per stirpes basically means by the family branch. So if you have two kids and one of them passes away before you, their share automatically goes down to their kids, your grandkids. But per capita, which means by the head, is different. In that same scenario, the deceased child's share gets split up among your other living children. The grandkids, they'd get nothing. It's a tiny detail that completely changes who gets what. Now, let's get into the nitty-gritty of the annuity contract itself. Because, and this is important, not all annuities are built the same. The specific type you bought years ago is what determines what your beneficiary actually gets, if anything at all. So, have a look at this. It really breaks down by the type of death benefit. Most modern annuities, the ones people are buying today, they'll pay out whatever's left in the account. Others are set up to continue making payments for a set period. But that one at the bottom, that's the one you have to watch out for. Single life only means exactly what it says. Income for your life, and that's it. When you die, poof, the payments stop, and the insurance company keeps the rest of the money. Your beneficiary gets zero. Ouch. Okay, so let's say your beneficiary gets the money. Awesome. But wait, Uncle Sam is calling. What about the taxes? Well, how an inherited annuity is taxed all boils down to one thing. Where did the money come from in the first place? And how it's taxed boils down to one thing, where the money came from. If it's a non-qualified annuity, meaning you funded it with after-tax money, then your heir only pays income tax on the growth. But if that annuity was inside a traditional IRA where you used pre-tax money, every single penny that comes out is fully taxable. And listen, that last point on the slide, it's a killer. You know how with stocks, when you inherit them, the tax bill on the gains kind of gets wiped clean? That's the step up in basis. Well, with annuities, that does not happen. All the tax on all that growth is still due. And just to put a number on it to see how real this is, a $50,000 gain in an inherited annuity could easily trigger a tax bill of $15,000 or more. That's not pocket change, right? That's a serious chunk of the inheritance that could vanish if you're not prepared. All right, we've covered the rules. Now let's talk about how to avoid the disaster scenarios. These are the most common traps that both annuity owners and their heirs fall into year after year. Here are the big 5. First up, naming your estate. Don't do it. It's like buying a fast pass at an amusement park and then choosing to stand in the longest line anyway. It sends the money right back to probate. Next, not updating your beneficiaries after a life event like divorce is a recipe for disaster. Forgetting to name a backup, a contingent beneficiary, is another classic. If your main heir dies before you, it's right back to probate court. And that last one, oh boy, just taking the lump sum without thinking about the tax hit is a classic mistake. It can bump your beneficiary into a way higher tax bracket and cost them a fortune. Okay, so after all those warnings, you're probably wondering, so what do I actually do? Don't worry, here's a clear, step-by-step action plan for any beneficiary navigating this process. This is the playbook. Follow these steps. First, you got to gather the paperwork, the policy, the beneficiary form, get the official death certificates. Call the insurance company and get the ball rolling. Now hang on, steps 4 and 5 are, without a doubt, the most important. When you get that claim packet, do not rush. Review every single payout option and figure out the tax hit for each one. This is where you pause, take a breath, and talk to a professional, a financial advisor, a tax expert. Once you have a smart strategy, then you file the final paperwork. And honestly, this quote just nails it. The claims process isn't just about filling out a form and getting a check. It's a huge financial decision, and simply checking the first box you see without understanding the consequences is exactly how thousands of dollars are needlessly lost to taxes. So, at the end of the day, what's the big takeaway here? Naming a beneficiary is step 1. It's how you protect the money from the courts and get it to your family. But step 2, which is just as important, is having a plan for the taxes. By knowing these rules, you make sure that the legacy you're trying to leave behind is the one that your family actually gets.